Hey everybody, and welcome to the deep dive. We're tackling a pretty monumental book in the investing world today.
Yeah,
Benjamin Graham's The Intelligent Investor.
a classic.
This book is legendary.
Absolutely.
I mean, Warren Buffett said it was the best investing book ever written. So
It's true.
we got a ton of requests from you all to dive into this one,
Yeah, we did.
and we're happy to oblige.
So let's get right to it. The Intelligent Investor, published back in 1949,
Wow.
and it's still considered the Bible of value investing. But don't worry, you don't need a finance degree to understand it or to get a lot out of it.
Right.
That's our goal today, make Graham's wisdom accessible to everybody, even if you're just starting out.
Yeah, for sure.
We're going to be exploring the core principles of value investing.
Totally.
And trust me, they're more relevant now than ever.
You know, I always think about when I hear value investing,
Yeah.
I'm thinking about finding those hidden gems. Like at a flea market, you find a vintage record player. Right. That's worth a lot more than what you paid for it.
Yeah.
Is that kind of the idea here?
You're on the right track.
Okay.
Value investing is all about finding those underpriced treasures, not in a dusty attic, but in the stock market. It's like being a detective looking for clues that reveal a company's true worth.
Okay.
So think of it this way.
Yeah.
You want to buy $1 for 50 cents.
Right.
In the stock market, that dollar is a company's intrinsic value.
Okay.
What it's really worth based on its assets, its earnings, and its potential for future growth.
Got it.
Value investors are all about finding companies whose stock price is lower than their intrinsic value. They're buying those dollars on sale, so to speak.
Okay, so then how do you figure that out?
Right.
How do you figure out a company's intrinsic value?
Yeah.
It sounds pretty complicated.
Well, it definitely takes some analysis,
Yeah.
but it's not rocket science.
Okay.
Graham gives us a framework for breaking down a company's financials, looking at things like their earnings, assets, debt, and management team. We can actually get a glimpse into a simple technique he uses later on.
Okay.
But first, let's think about this. Even if you found a company that seems undervalued,
Right.
the market doesn't always agree with you right away.
Sure.
That's where Graham's brilliant idea of Mr. Market comes in.
Ooh, Mr. Market. That
Yeah.
sounds pretty intriguing.
Yeah.
Tell me more about Mr. Market.
Okay, so picture this every day. Mr. Market comes knocking at your door, offering to buy or sell stocks.
Okay.
Now, he's a bit of a whimsical character,
Huh?
prone to wild mood swings.
Okay.
Sometimes he's euphoric, willing to pay top dollar for anything.
Okay.
Other times he's gloomy, practically giving stocks away for pennies.
Right.
But the thing is,
Yeah.
his prices aren't always rational.
Okay.
He lets his emotions get the best of him, which creates opportunities for the intelligent investor.
Okay, that's a really cool way to visualize it.
Yeah.
The stock market's ups and downs. So Mr. Market is basically the embodiment of all the emotional traders out there.
Right.
But how do we avoid getting swept up in his craziness?
Yeah.
It sounds like it'd be really easy to get caught up in all that frenzy.
You're absolutely right. It is easy to get caught up in the hyper panic.
Yeah.
That's why it's crucial to understand Mr. Market's game.
Oh. Yeah.
He's not your friend, and he's not always right. Instead of reacting to his every whim, learn to use his emotional swings to your advantage.
Okay.
So when he's overly pessimistic, that's your chance to buy those undervalued gems we talked about.
Right.
And when he's overly optimistic, well, maybe it's time to consider selling.
Okay, so this is like we're learning to read the market's emotions to our advantage.
Exactly.
But how do we know when he's being truly irrational
Yeah.
and not just reacting to like real changes in a company or the economy?
Well, that's where Graham's emphasis on deep analysis comes in.
Okay.
We need to look beyond the headlines and dig into the fundamentals of a company. Are their earnings solid? Do they have a competitive advantage? Is their management team trustworthy? By carefully researching a company, we can estimate its intrinsic value
Right.
and then compare that to the price Mr. Market is offering.
Right.
If the price is significantly lower than our estimate, that's a good sign that Mr. Market might be letting his emotions get the best of him, creating a potential buying opportunity.
So we're using logic and research
Yes.
to beat Mr. Market at his own game.
Exactly, you're getting it. And that's why Graham's ideas have stood the test of time.
This is great. I'm hooked.
Good.
I'm ready for more. So what's the next step on our value investing journey? Where do we go from here?
Well, now that we understand the importance of analyzing a company
Right?
and recognizing when Mr. Market is being irrational,
Right.
we need to talk about protecting ourselves from the inevitable bumps in the road.
Okay.
Even the most careful investor can make mistakes
Sure.
or encounter unforeseen events. And that's where Graham's concept of the margin of safety comes in.
Ooh, margin of safety.
Yes.
I love the sound of that.
Okay.
Like a financial safety net.
You got it. So think of it like this. You're buying a used car.
Yeah.
You do your research.
Right.
You check under the hood. You take it for a test drive.
Sure.
You think it's worth $5,000, but the seller is offering it to you for $3,000.
Okay.
That's a pretty good deal, right?
It is. Yeah.
Even if you miss something in your inspection or there's a hidden issue that pops up later, you've got that extra $2,000 as a buffer.
So it's like a built-in discount just in case something goes wrong.
That's exactly it.
Okay.
The margin of safety works the same way in the stock market.
Okay.
You want to buy stocks at a price that's significantly lower than their intrinsic value.
Okay.
That way, even if your calculations are a little off or the market takes a dip, you've got a cushion to protect you from losses.
Wow, that's incredibly smart.
Yeah.
I'm starting to understand why this book is so revered. He's not just teaching us how to pick stocks. He's teaching us how to think.
Right.
Like intelligent investors.
A mindset.
And how to approach the market in a really safe way and look at long-term success.
You nailed it. And that's what makes his work so enduringly relevant, even in today's fast-paced market.
This is mind-blowing. We've learned about the importance of finding those undervalued companies.
Right.
Using Mr. Market's mood swings to our advantage.
Yep.
And building in that margin of safety to protect our investment.
Exactly.
What a powerful combination.
It is.
And there's so much more to uncover.
There is.
So stay tuned, because in part 2, we'll delve deeper into Graham's strategies for actually picking those winning stocks.
Looking forward to it.
And we'll explore how you can tailor his approach to your own investment goals.
Yes.
See you soon.
See. Welcome back to the deep dive.
Glad to be back.
Before we jump into picking those winning stocks, there's one more crucial concept from Graham.
Okay.
That we need to talk about the difference between investing and speculating.
You know, that's something I've always kind of struggled with. Like, what exactly sets those two apart?
Yeah.
Seems like everyone's just throwing money at the latest trends these days.
Right.
And some people are getting lucky. Is that really investing?
It's a great question. And Graham addresses this head on in the book.
Okay.
True investing is about careful analysis, focusing on the long-term value of a business,
Okay.
and aiming for a reasonable return
Right.
while protecting your principal.
Okay.
It's like planting a tree and nurturing it so it can grow and bear fruit over time.
I like that. Yeah.
Slow and steady.
So what about speculating then?
Yeah, so speculating is more of a gamble.
Okay.
It's often based on short-term trends, market hype, or even just plain luck.
Right.
It can be exciting for sure, but it's also much riskier.
Yeah, for sure.
Imagine trying to time the market perfectly.
Right.
Buying and selling based on rumors or fleeting trends.
Uh-huh.
That's speculation, and it rarely ends well in the long run.
It's like playing the lottery, right? You might hit the jackpot.
Right, yeah.
The odds are stacked against you.
Exactly. And Graham wants us to be thoughtful, disciplined investors, not reckless gamblers.
Okay.
He emphasizes that building wealth takes time, patience, and a solid understanding of what you're investing in.
Makes sense to me. So how do we avoid falling into that speculation trap?
Yeah. So first and foremost, he stresses the importance of doing your research.
Okay.
Don't just jump on the bandwagon because everyone else is doing it.
Right.
Instead, take the time to understand a company's business model,
Okay.
their financials, their management team. Look for companies with a proven track record and a solid plan for the future.
So it's like buying a house. You're not just going to buy the first one you see.
Right.
You're going to inspect it carefully, make sure the foundation's good,
Right.
make sure it's in a good neighborhood.
That's a perfect analogy.
Right.
And just like you wouldn't want to overpay for a house, you
Right.
don't want to overpay for a stock.
Yeah.
Graham encourages us to be patient. Wait for those opportunities when a company's stock price is significantly lower
Yeah.
than its intrinsic value.
Right.
That's when you're getting a real bargain.
I'm starting to see how all these pieces fit together.
Yeah.
It's not about getting rich quick.
Right.
It's about building that solid foundation for long-term financial success.
Exactly. And that brings us to another important concept that Graham emphasizes,
Yeah.
the importance of temperament.
Okay.
You know, it's not just about having the knowledge, it's about having the right mindset to apply that knowledge effectively.
Okay, temperament.
Yes.
So that's about staying calm and collected when the market is going crazy.
Yeah.
Right.
You got it.
That's easier said than done.
Easier said than done. Absolutely.
So how do we cultivate that kind of emotional discipline?
Right. So Graham recognized that the market is driven by emotions,
Okay.
fear and greed.
Uh-huh.
And as human beings, we're all susceptible to those emotions.
For sure.
But the intelligent investor learns to detach from those short-term fluctuations of the market and focus on the long-term fundamentals.
Okay.
They avoid making impulsive decisions based on fear or greed.
Right.
They stay the course even when things get bumpy.
I am definitely guilty of letting my emotions get the best of me sometimes, especially when I see that portfolio dipping.
It's a journey for all of us.
Yeah.
But Graham provides invaluable guidance in the book.
Okay.
He reminds us that the market is cyclical.
Okay.
There will always be ups and downs.
Right.
The key is to not panic when things are down.
Right.
And to not get carried away when things are up.
Easier said than done.
Right.
Yeah.
But yeah, remember Mr. Market we talked about?
Yeah.
He's always going to be swinging between those extremes.
Yeah.
But we don't have to play his game.
Right. Use it to our advantage.
Exactly.
This is so helpful.
Yeah.
I'm starting to feel like I have a superpower.
Good.
Like I can rise above all the chaos.
Yes.
And just make rational decisions based on solid principles.
That's exactly the mindset we want to cultivate.
Yeah, I love it.
So now let's dive into another insightful aspect of Graham's approach.
Okay.
He acknowledges that not all investors are the same.
Right.
Some have more time and expertise to devote to investing,
Sure.
while others prefer a more hands-off approach.
Right. Like some people I know love to spend hours researching stocks.
Yeah.
And other people just want a simple set it and forget it strategy.
Sure.
I'm more in the latter camp for sure.
Yeah, you're not alone. And that's why Graham outlines two main types of investors.
Okay.
The defensive investor and the enterprising investor.
Okay, tell me about these two.
All right. So the defensive investor, as Graham describes them, is someone who prioritizes safety and simplicity.
Okay.
They're looking for a solid, reliable portfolio that requires minimal effort.
Right.
And offers a reasonable return over the long term.
Okay.
Think of it as the set it and forget it approach to investing.
That sounds perfect for me.
Okay, so what kind of portfolio would a defensive investor typically have? Graham suggests a simple portfolio mix of high-grade bonds
Okay.
and a diversified selection of blue-chip stocks.
Blue chip stocks?
Yeah, blue-chip stocks are shares of large, well-established companies with a long history
Okay.
of stable earnings and dividends.
Okay.
Think of companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble.
Those are big names.
Yeah, the kind of companies that have been around for decades and are likely to continue to be around for decades more.
Right, so they've kind of proven themselves
Exactly.
over time.
Right. The defensive investor isn't trying to beat the market or pick the next hot stock.
Right.
They're aiming for steady, consistent growth over time.
Okay.
And remember, diversification is key. By spreading your investments across different asset classes and sectors,
Right.
you're reducing your overall risk.
This is all starting to click for me.
Good.
Now, what about those enterprising investors?
Yeah, so the enterprising investor, as you might guess, is a bit more adventurous.
Yeah.
They're willing to put in more time and effort, dig deeper into company financials, and actively seek out undervalued opportunities.
Okay.
They're not afraid to roll up their sleeves and do their homework because they're looking for those market-beating returns.
So they're more like stock market detectives.
I love that analogy.
Hunting for those hidden gems that most people overlook.
Yes, they're looking for those companies that are temporarily out of favor with the market, but have strong underlying fundamentals. They might be going through a rough patch, or their industry might be facing some challenges, but the enterprising investor sees an opportunity where others see risk.
It sounds like they need a pretty strong financial background, or at least a willingness to put in a lot of study time.
That's true. The enterprising approach requires more knowledge and effort, but it also has the potential for greater rewards.
I'm sure.
Graham provides specific guidance for these investors, including detailed frameworks for analyzing financial statements and calculating a company's intrinsic value. He even introduces a simplified method for finding potentially undervalued stocks called net working capital, which we can delve into later if you're interested.
That's fascinating.
Yeah, it's a deep dive.
Yeah, it is. I'm starting to see how this book can cater to different types of investors.
Yeah.
From the more cautious to those who are ready to take on a little bit more risk.
Exactly.
But whether you're defensive or enterprising, it seems like Graham's core principles still apply.
They do.
Do your research, be patient, and don't let your emotions drive your decisions.
You got it. And that's the beauty of Graham's work. It provides a comprehensive approach to investing that can be tailored to your individual goals, your risk tolerance, and level of involvement. It's all about making informed decisions and building a portfolio that aligns with your unique circumstances.
This has been so eye-opening.
Good. I'm glad.
We've covered so much ground. but I'm eager to learn more about those specific strategies and techniques that he outlines.
Me too.
Can't wait to unpack those in part 3, so stay tuned, listeners. Welcome back to the deep dive. This book has really changed the way I think about investing.
Yeah.
Like, Graham is handing us this roadmap to navigate, the often confusing world of the stock market.
For sure.
But how do we actually put all this wisdom into action?
Right.
Like, what specific steps can we take to build a solid, profitable portfolio?
Well, that's the million-dollar question, right? And the great thing about Graham is he doesn't just leave us with these abstract concepts. He gives us concrete, actionable strategies that we can apply, whether we're defensive investors seeking stability or enterprising investors on the hunt for those undervalued gems.
Okay, so let's start with those defensive investors.
Sure.
The folks that are looking for, more of a hands-off approach.
Right, the set it and forget it.
Set it and forget it. What's their game plan?
Yeah, so for the defensive investor, Graham recommends what he calls a formula approach. It's all about creating a balanced portfolio that's designed to weather market storms and deliver consistent returns over time without requiring, constant monitoring or complex analysis.
Okay.
So think of it like building a sturdy house.
Okay.
That can withstand the elements.
I like that analogy.
Yeah. So what are the building blocks of this sturdy house? What kind of investment should a defensive investor focus on?
Yeah.
Graham suggests a mix of high-grade bonds and a diversified selection of large established companies, commonly known as blue-chip stocks. Remember those companies we talked about earlier, like Coca-Cola or Johnson & Johnson?
Right.
Classic examples of blue-chip stocks. They have a long track record of stability, consistent earnings, and often paid dividends, which is like getting a little bonus on your investing.
So it's like having a diversified diet for your portfolio.
Yes.
A little bit of bonds for stability, a little bit of blue chip stocks for growth and income.
You got it. And the beauty of this approach is that it doesn't require you to be a stock market expert. You don't need to spend hours poring over financial statements or trying to time the market. You're simply investing in solid, well-established companies that are likely to continue to perform well over the long term.
This sounds perfect for me. Somebody that's got a busy life and can't dedicate hours and hours to researching individual stocks.
Sure.
But what about those enterprising investors?
Right.
The ones that are ready to, roll up their sleeves and do a little more digging. What's their strategy for finding those hidden gems?
All right, so for the enterprising investor, things get a bit more exciting. They're the stock market detectives always on the hunt. For those undervalued companies that the market has overlooked, their strategy involves a deeper level of analysis, looking for clues that reveal a company's true worth and potential for future growth.
So what are some of those key clues that we should be looking for?
He outlines several factors to consider. And these might sound a bit technical, but bear with me, I'll break them down. First, he looks at a company's financial strength. Are they profitable? Do they have a healthy balance sheet with manageable debt? Second, he examines their earnings stability. Are their profits consistent, or are they all over the map? Third, he looks at their dividend record. Have they been consistently paying dividends to their shareholders? And fourth, he considers their long-term growth potential. Is the company in a growing industry? Do they have a competitive edge that will allow them to thrive in the future?
Wow. That's a lot to consider.
It is.
It sounds like a pretty thorough investigation.
It is. And remember, Graham provides specific ratios and benchmarks that can help you analyze these factors. For example, he talks about the price-to-earnings ratio. Or PE ratio, which compares a company's stock price to its earnings per share. A low PE ratio can be a sign that a company is undervalued. He also introduces this simplified method for finding potentially undervalued stocks called net working capital, which essentially involves looking for companies whose current assets, minus all liabilities, are greater than their market capitalization. Now, don't worry if that sounds complex. The main takeaway is that there are concrete metrics we can use to evaluate a company's financial health and potential for growth.
So this is where the book gets really powerful.
Yes.
It gives us those practical tools and techniques that we can use to actually, make informed decisions.
Exactly.
But I'm sure some listeners are thinking, okay, this all sounds great, but where do I even begin? I don't have a finance degree,
Right.
and I don't have hours to spend researching companies.
You're right. Not everyone has the time or expertise to become a full-fledged stock picker.
Right.
But the good news is that there are resources available that can help you apply Graham's principles without having to become a financial whiz.
So tell me about some of those resources.
Okay, so one option is to look for mutual funds
Okay.
or exchange-traded funds, ETFs,
Okay.
that follow a value investing strategy.
Okay.
These funds are managed by professionals who do the research for you, selecting stocks that meet Graham's criteria.
So it's like having a team of expert stock pickers working for you.
Exactly. And another option is to work with a financial advisor who specializes in value investing.
Okay.
They can help you create a personalized portfolio that aligns with your goals and risk tolerance.
That's really helpful. So even if I'm not ready to dive into the deep end of stock picking,
Right.
I can still benefit from his wisdom.
Absolutely.
But let's say I'm ready to start picking my own stocks.
Yeah.
What's the best way to get started?
First and foremost, I highly recommend reading The Intelligent Investor carefully.
Okay.
Make sure you understand the core principles we've been discussing. There's also countless online resources and books that can deepen your understanding of value investing.
Okay.
And don't be afraid to start small.
Yeah.
You don't need a huge amount of money to begin investing.
Right.
The important thing is to develop a sound strategy.
Right.
Stick to it
Yeah.
and be patient.
The patience is key.
Absolutely. Graham keeps reminding us that investing is a marathon, not a sprint.
For sure.
And one final thought I'd leave you with is that investing is a journey, not a destination. The market is constantly changing, and there's always more to learn.
Right.
Embrace the process.
Yeah.
Stay curious.
Uh-huh.
Never stop seeking knowledge.
Such wise words. And I think his principles can be applied to so many areas of life.
I agree.
Not just investing.
Yeah.
It's about being thoughtful, disciplined, making decisions based on, sound principles, not fleeting emotions.
It's a philosophy for life.
Well, on that note, I think we've covered a lot of ground today.
We have.
We've explored the core principles of value investing, learned about the importance of temperament and analysis,
All right.
and discovered how to apply Graham's wisdom to build that solid portfolio for the long term.
Absolutely.
If you're ready to dive deeper into The Intelligent Investor, we've got a link to the book in the episode description.
Check it out.
Trust me, it's an investment that will pay dividends for years to come.
It will.
And as always, thank you for joining us on the Deep Dive.
Thanks, everyone.
We'll be back next week with another fascinating topic and a whole new stack of insights.
See you then.
Until then, keep those brains buzzing and those knowledge quests going.